All right. So property taxes in Florida. So now we know what we do on Liberty, right? We do videos. All right. So super big topic, especially this time of the year, just for the fact that when we're closing now, taxes are due in November. We're collecting for the whole amount. The client's expectations is the taxes what they're now, and that's what I'm moving forward with, right? And in most cases, many cases, that's not the case, especially if it's new construction, whether it may be qualified with the way the taxes are going to be the following year, but they're still making the payment that, whatever, $300 on the land, $30 a month or what have you. So then they get clobbered down the road almost every time. It's hard to go back a week where I don't get a client introduced by an agent or a financial advisor or my CPA that says, hey, that happened to me 5 years ago. It was a horrible experience. Or, hey, I bought a house last year or 2 years ago. Look what just happened. Or 6 months ago for that matter. It can happen sooner too, depends on the circumstances. So the idea is to learn how to calculate that. You can do this in any county, in every county in Florida. And since 1998, I've yet to see a county in Florida that doesn't have access to doing that. There may be one, but definitely not Central Florida. I mean, Miami, Jacksonville, Tallahassee, I mean, all the places where we do loans. But Volusia, Orange, Seminole, Polk, Osceola, Hernando County, Brevard County, all these counties have a way to do it. So, anyways, super, super easy. So let's oh, I probably should share the screen, right? It's probably a good idea. Put a little face up here. And let's go to all right, let's see. Let's go here. Let's open up a new website. All right. So what I do is I have all my counties saved on my favorites. I'm on because I'm always going there, but let's say I didn't save that particular county. You're just in a rush or you're in somebody else's computer. So homes for sale in Polk County, Florida. Florida. All right. So Polk County homes for sale. I'm just gonna look for a house in 380,000. Just want to go to a place where we can get like a close to $400,000 range. Whoa, look at that game. Good heavens. Okay, so on Zillow, you can do that in any state. Most states you have to pay for this information. So we're looking Florida that it's easy. But if you right, my computer's a little bit slower when I'm taping, I guess. All right, so let's go to taxes. Off the top, I already see a problem. So this has been sold for 380, right? It looks like the last time it was sold 10 years ago for 157,000. So this is a homesteaded property. Chances are the assessor for the county, if that was the property value at the time, the actual property value that an agent sold his house for, on the property appraiser's website, is not going to have that same value. It's going to be lower. I don't know, maybe, whatever, 120, 110, usually 15, 20% less or something. And then they have the assessed value. So that's a little bit lower even, right? So I already know these taxes are going to be way lower for this guy. So look at this, $2,000. So you and I both know that does not jive with 380 in any way, shape, or form, right? So this is a typical one. So we got a good one. Goody, goody, goody. All right. So what happens when we pre-approve a client for a house, and I tell them it's $400,000 purchase price. We didn't really pre-approve the client for $400,000. $400,000. We pre-approved them for a mortgage payment, period. But if I tell the client, hey, you're approved for $3,300 or $3,000, depending on how much down payment or whatever the case may be, they really can't do much with that information. So what I do is, let's say in Polk County, I already know what that tax should be. So that's what's on my mind when I give them that pre-approval. Now, when the client sees this, this is 380,000. Roberto said for every 10,000 is like $60. So wow, this house is really cheap. The taxes are low. That's why. Okay, we're gonna be real. This house is great. So they may be making a decision on buying this house just because the taxes are low, and not on the house next door that was also maybe 380, and the taxes were quite a bit higher. Well, maybe the one that sold next door sold 6 months ago for 340,000, or that wouldn't be a good idea because that wouldn't have taken place. But let's say it sold last year. and the taxes were already set, for example. So we want to make sure they're making that decision. And that's tough for a client sometimes because due to taxes and insurance, if I pre-approve a client for 400,000, there's a house out there for 370 that they don't qualify for. And there's one for 425 that they do qualify for. So, I know it's a lot for them, but nonetheless, not to get off the subject. So let's go with this. So right now, let me get my handy calculator out here so we can, up some outer screen. Where is it? Get there. Here you go. Let me bring it over here. All right. So taxes, $2,100. Wow, 175 a month. That's a good deal. We'll put it a little bit here. That way we can see it right there. Cool. All right. So, before I present this property, let me calculate what those taxes are going to be next year, because maybe they want the house next door that has a pool is the same price and the taxes are a lot more, maybe closer to what they're actually going to pay on this house the following year, and then now they're buying the wrong house. Let's get them the house with a pool. Your taxes are going to be the same if you're buying in that county or on that street and the house is 400,000, and one's got the taxes at 7 and the other one's got the taxes at, I don't know, just the ad valorem 500 a year because it's 100% disabled veteran. Yeah, ain't gonna be your taxes next year. Your taxes are gonna be the same on those two properties the following year or maybe sooner. So that's kind of what we want to do, right? So let me show you these. You go to, anytime you're in Zillow, you go to where the taxes are. You see this little link down here, county website. These works in every county in the U.S. Now, in a lot of states, it doesn't take you anywhere. In most states, or many of the states that I've had to, like if we're doing a bridge loan, let's say, to buy a house here, we kind of do some of this work too in other states. We have to pay for it. You got to go through all these links. So we're really lucky in Florida that we don't have to. Now, Polk County, sometimes, notice how it brought me right into the address. Oh, wait, let me double check this. Yeah, milestone. I mean, I always have these websites open, so they kind of stay open in the background, when you go to websites a lot. But many times, it won't take you right to the page itself. In other words, it'll take you here, homepage. See if I can go back to it. Yeah. So it'll take you to the homepage instead. General, and like in Volusia County where I live, it takes you to the homepage. They updated it the past couple of years, and now it doesn't work as good. But so you go to property search. We don't know the owner of that property. I don't know who owns it. I guess I can find out, right? But let's go here to site address, right? And then what's the address again? 114 Milestone. 114 mile. You see, it comes up already. The reason why I'm doing that exercise is because on some of the websites you have to put the address, some not. So you have to learn where to go. So wherever you do the most business, just learn that website. If you want a cliff note on any, instead of spending 2 hours on it, give me, hey, Roberto, I'm in Hernando County, I'm in Brevard County, Orange County, whatever county, and I can usually off the top of my head, I go on there and like in 5 minutes, I'll get you rocking and rolling. But anyway, so we put the address and we click search. Boom. I'm gonna copy this. I already know where I'm going, so obviously you would have to go back to that, but just roll with me for a second. All right, so we're gonna click this. So I want to make sure I have the right address. So I go back to Zillow because I made that mistake before, right? This is where I copy and paste this, by the way, the full address, and I go to the FEMA website to make sure it's in the flood map. I'm not saying 9 out of 10 times, but it's hard to go 1 month without seeing the MLS. It says it's X zone when it's A and B. So I always check my own flood zone on the FEMA website. Nonetheless, let's stick to the subject. Sorry. All right, so we got the address here. I'm going to come down here. I can click here and see the deed, see if it was foreclosed or anything. I can do all kinds of research on here. I mean, this is like major underwriting stuff that you can get ahead of time. Really pre-qualify the property. Look at this exemption, 50,000. Okay, so they got a really good homestead exemption on this house. Look at this taxable value, 100,000. Oh Lord heavens, 125, 125, 120, 100. So depending what the tax is for, is how they assess that. But obviously these taxes are assessed way lower. Way lower. Look at this, 2147, and then the ad valorem. Sometimes that's included in Zillow, sometimes it's not. So be careful. Zillow said 2,100 and you're really at 2,500. You saw it down here? So be aware of that. It just depends on the county, and sometimes within the county it's different. It's just, you really want to go to this website to get a lot better numbers. Anyways, okay, fine, Roberto. 2,100. What's the damn tax? Okay, well, in this website is right here, tax estimator. All kinds of goodies up here too, by the way. But go to tax estimator, click that. Yeah, I agree. You got to click that. You got to click that. All right, cool. What we're paying? Oops, already forgot. 380. Let's say we're gonna offer full price and ask for closing costs, please. I like that. And enter the new home 18-digit partial. That's already there in this particular county or municipality. We don't have to worry about that. Will the new property have homestead? Polk County automatically puts yes. You got to be careful. If this is a second home or investment property, then you want to hit no, right? So we're going to leave it at yes. Enter populate portability amount that will be applied to the new home. We're going to do that in a minute. We're talking right now about a first-time home buyer or somebody who has not owned a home in Florida and they're buying a primary residence, okay? Very different if you got someone moving back into the rental property, into the vacation home, or maybe they just sold the other house or going to keep the departing property to rent and move here. So that's portability. That's the next thing we're going to talk about. But right now, we're going to calculate next year's taxes. We're thinking they're $2,100. Holy cow, look at that number. 6,300 to 7,178. My gosh, that's almost $400. Let me take a deep breath here. Now, I'll tell you what, I bought my first home in 1998, bought and sold quite a few, financed a couple for sure. And usually when it comes to underwriting, in this case, this is how this works. This is part of the conversation, so this is important. I like to go off on tangents, but when an underwriter sees this, let's say we have someone with a 750 credit score, and they're putting 5-10% down or whatever, and debt ratio is 35, or they're just going to go with that. They're not going to have a problem. At this time of the year, they're actually going to use the new millage that came out already for the next year. But might be a couple of $100 more. But they're okay with that. But if it is a borderline client where they barely have money, barely making ends meet, credits borderline, they're approved, well, they're tight, they're going to want the calculator. And that's a problem. Because if they're tied at this number, let's say I really pre-approved them for 350 and then we found this house, that's when we're taking that risk. That this could, that first week, could go to underwriting, and then you can come back and say, hey, get the calculator, and then send it back in. And then we're dead in the water, right? So sometimes if we have time, we want to pre-approve those, send it to the lender. Hey, we're going to do this. The numbers are tight. I just want to run it by you. And they know what I'm doing, but sometimes they'll give us grace with that, and depending on what lender and what underwriter I get, so I kind of have a pulse on that. Well, that's iffy for those type of clients. Nonetheless, going back to the task. So the point I was trying to make is that it's okay to use this lower figure because it's rare that you have an estimate that high. I mean, that's more for legalities that counties do this. So let's use 6,400 as an example, right? So we know right now the taxes are 2,100, and let's say that's 175 a month. But instead, we know they're going to be up to, what did we say? Shoot, I already forgot. I'm sorry. 63. Let's say 6,400. So 6,400 minus 2,100 should be 400. $4,300 divided by 12. Okay, maybe a little less, like 390, 358. All right, I like to do math in my head and challenge myself. So look at that. This is what's going to happen. Right now, it's September the 5th, 2022, Labor Day. Let's say we close on this deal on September the 15th to make the numbers easy. That's a real quick clear close. Just roll with me. All right, so we close. So as you know, we're going to pay interest from the day we close to the end of the month. And then a whole month's got to go by. Over. So, that's going to be November 1st is the first payment. But taxes are due already. So really what the title company most likely is going to do is they're going to grab $2,100 altogether, mostly from the seller, up until 9/14. And then the rest of the money, maybe $400 or whatever, 500. They're going to grab that from the buyer. And then they're going to have that money there, and they're probably going to go ahead and send that. I mean, they may send it to the mortgage company or for a mortgage company to pay the taxes. If it's too tight, they may just pay the taxes and then send that tax bill to the mortgage company. So what happens now? The mortgage company, remember, they're doing thousands of loans. This is a new loan. Hey, we're closed in September. The taxes are already paid for the year. Here's a bill, 2,100, and it's calculated at 175 a month, right? Okay, right. Let's just say the mortgage ended up being, just to make my math easy, they put more money down. Let's just figure it out. Okay, so 2,175 a month. Okay, great. Well, guess what? The mortgage company's collecting just about 175 every single month. But what's going to happen next year when November comes around? They're going to get a much bigger tax bill. They're going to get a tax bill of about, we said 6,400, right? And then as we put down here, minus the 2,100, that's 4,300. And then divided by 12, that's 358. I don't have to do the math again. So let's put 358 here. So they're going to tell that homeowner, hey, homeowner, we got good news for you. Your bill came in. We went ahead and paid it on your behalf. However, you're short $4,300. Can we have that? And the homeowner might say, wow, I can't really part with that right now. Not to worry. Mortgage company's going to pay for it. Interest rate, 0. It's not many times in life you get something for free, right? There's a reason why they're doing it. If the county forecloses on the property due to taxes, they don't have to pay the mortgage, and the bank's out of the loop. So that's why banks always pay for those taxes when you're short, just so you know. Nonetheless, going back to this. So now the client says, well, what do I do? Well, Mr. Client, don't worry about it. We're going to pay that difference of $4,300. We already had the 2,100. But wait a second. How much are the taxes? Oh, they're 6,400. My realtor didn't tell me. Loan officer didn't say anything either. Who's responsible for this? You are. So they start calling their realtor and the loan officer, right? So that's why I want to make sure we have this conversation up front. So your mortgage is going to go up $358 to recover that over the next 12 months. And then once it's paid off, then it goes back down. Oh, okay. It's going to go back to the 2,175. Not so fast, buddy. What are you talking about? Well, we already know your taxes are going to be a lot. This is not a one-time thing. Your taxes are going to be about $360 more a month every year. And then they're going to go up a little bit more every year, right? Whoa. So really what we need to do is we need to take that 358 to collect the 43, the shortage that we have in of 4,300. Plus, we know your taxes went up that much. We don't have the same problem. You don't want the same problem last year. Of course not. Not to worry. You're going to raise your taxes, set your tax collection and escrow $716. So the good news is that for the next 12 months, instead of 2,175, you're going to pay 2,891. The client didn't bargain for this. It's not a lot of people that can just add another $716 payment to the life for 12 months. What if they don't have retirement? What if they moved in the house, they changed this, they put solar panels? Don't get me started on that. They painted it, they live, maybe somebody got sick, whatever. Now they got to pony this up for 12 months. And once the damage is over and done with, then back after 2,506. And that's maybe time to sell the house. Oh my gosh, what a disaster. So that's what we want to avoid. And that's kind of how that works. So we got to be real careful with that. Now, for a second now let's assume for a second that this person, this is the next scenario. I want to talk about the portability now, which is also something you would need to calculate, because you don't want to do that for somebody selling their house and you calculating their taxes higher. They're going to say, never mind, I'll stay on my house. I won't sell my house and I won't buy a new one. And now you're out of the loop because you calculated this wrong, right? So let's say that they own a property that the property accounting appraiser's website says has a valuation, just market value of 300,000, and let's say that their assessed value for taxes is 200,000. Let's say I just went to that website. Let's just assume that for a second. So the difference is 100,000. That's the portability. So in other words, if somebody in the past 24 months owned a house in Florida and it was their primary residence, they can take that discount and bring it to the new house. Why should they lose it? Why should they start from scratch? That's pretty fair. But when they file their homestead, if they forget to file the portability, they missed it, they lost it forever. Super important. 40% of our business is repeat clients. Happy birthday, holidays, the homestead phone call, the portability phone call, those are all value added phone calls. That way, when they think real estate again, they think of us. And that's how you can increase your capture rate. Every time you get a client in, not only should they be referring you business, but also coming back at you, right? Most clients don't come back to the same realtor, definitely not the same loan officer, right? Unless we do something. So this is something huge, and no realtors do this. Very few loan officers do it. That we can show them and empower them. Go to the website and do it. You know. So nonetheless, okay. So let's assume for a second now we're going to talk about the next thing, portability. So portability allows you to have $500,000 worth of discount from your previous home into the new home. So now, if it's more than 500, oh well, that's the max. I haven't had that problem yet. I guess I got to do more jumbo loans, but it would have to be a lot of money. Like you're buying a $3 million house and you just got out a $1 million house or something like that. But let's go back down to where. So we already established you're going to sell their house, and the county assessor says it's worth 300, and their assessed so their just market value is 300, and the assessed value is 200,000. Therefore, the difference of 100,000, that is the portability. So let's see. It's different every website. You got to read a second. And this is kind of like driving. Like you get there and you don't remember taking the street. Well, how do you give directions, right? So I kind of know how to do it, but to show you, I kind of have to read through it. So roll with me for a second. Option one, if prior name if prior home is in Polk County, find the Polk County property home prior to portability name, blah, 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 blah. There's no portability amount on the parcel. Or option two, the prior home not in Polk County, use a portability calculator to estimate portability and enter the amount. So let's just go with that for now. All right, let's see. Enter market value of the new home, 380,000. That's this property we're working with, right? Okay. Enter the market value of the prior home in year homestead was relinquished, which would be this year. Remember, maybe you're selling it for 320, but the property appraiser said the just market value is 300,000. So let's put 300. Enter the Save Our Homes tax, which, by the way, this happened back in 1992 when we said, hey, we want to save our homes, so taxes don't go up more than, for primary residents, 3% of the total amount, or the CPI, the Consumer Price Index, whichever is lowest. That's why your rental property, you pay a lot of taxes. That's why primary residence, you don't, right? Not as much, that is. So Save Our Homes difference. So the maximum is 500,000. So like we said, the county said that departing properties has a just market value of 300. The assessed value is 200. The difference is 100,000. So I'm going to plug in $100,000 here. Now remember, these works a little bit different in every county. So just learn to use your county. Calculate 100,000. Estimate taxes with this portability benefit. Now you click here. Now it brings you back here to, oh, you got to say okay again. Yeah, I read that. Of course, you got to be in agreement. That's why they estimate and they give you a range to kind of give themselves an out, so they don't want to be sued, right? So now we got that 100,000 plugged in there. I don't think I could have plugged in the 100,000 by itself. I remember. Anyways, just a thought. Calculate estimated taxes. Down. Oh, look at that. The ID. Remember how at the beginning I copied the ID? I know I was going to need it. But basically what you have to do is go back to right here, and it's right here. Partial details, right? So that's what they're asking you for here. Enter the new home 18 digits. So that's the new home partial ID. Again, every county you got to learn. Calculate estimated taxes. Look at that. 4565. Let's call that $4,600. That's definitely better than the $6,400 we were looking at before. 4,600. Oops. 4,600 minus, we're looking at what, 6,400. That's $1,800 better. That's $150. Yeah. Right about 150 is 12 months. I like doing math backwards. I know I'm sick that way. I'm kind of like the Rain Man thing going. All right, cool. Sorry, I should do it the right way, not to confuse anybody. All right, I'll do it right. So 1,800 divided by 12 months equals 50. All right, super. So now we know that this person taxes, instead of going $383 or $86, I think it was, if it's a first time home buyer, that would be accurate. In this scenario, it's only 150. So you see, that's another reason why it makes sense to sell your house now, because you have this additional benefit that most homeowners don't have. And now, yeah, your taxes now are going to be 175 only, and then you're going to add 150 next year, but that's okay. Better yet, come January this year, start putting aside that extra 150. Not only are you getting used to doing it, but when you get the $1,800 bill at the end of the year, you already have the money. That makes a lot of sense. So you can actually start sending it to escrow. The only problem with that is that a lot of mortgage companies will say, "Hey, whoa, time out. You're only supposed to pay 150, and you have too much, and by law we can't have that much. Here's your money back." So that's when the client's got to manually call the mortgage company, and they can adjust that for him, have him sign a waiver and stuff. There's a way to do all that, and I help them do all that. Again, that's another touch point, so that way they stay with you. They're like, "Man, I can't live without my realtor or my loan officer." Repeat business, baby. Increase that capture rate. That's how we do it. We don't have to buy leads. We just have to work the people that we have. Okay. So nonetheless, so that's kind of how portability works and homestead exemption, which is super important, works. You already know the limit, 500,000. The law started in 92. You tell them all this stuff that, wow, my realtor knows my stuff. So hopefully this will help you. Again, whatever county you want, you can do this in every county, as far as I'm aware of in Florida. If there isn't one, I guess we got to call the appraiser's office. I haven't had to do that, but, I guess it's always the first time. Anyways, hope that helps, and have a good rest of the holiday weekend. Take care.